Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. I'm really excited about the show today. When we had Grant Williams on the show earlier this year, he said we had to have his buddy Raj on the show to talk about his new book, Sports Perfect Storm, an Industry Now Totally Adrift. Roger is the founder of Albachiara, which offers consultancy services and does early-stage venture investing, mostly around sports and entertainment. Roger started his career on the finance side of things and later became the inaugural CEO of the Scottish Premier League in 1998. Today's episode is going to be all about the business of sports and where Roger sees it going in the future. Hopefully this gets you excited for the Olympics, which are just getting underway. Roger, welcome to the show.
My pleasure to be here, Meb. It really is a privilege. Thank you.
And here is somewhere pretty cool. Where do we find you today?
I live in the north of Italy, just above Milan on the border of Switzerland, a place called Lake Como.
I'm going to hit you up. I have my number one saved folder on my Instagram. I grew up as a big skier, but I kind of want to go in the summer. Is all about the Dolomites. I've never been.
Perfect.
Spent a lot of time in Italy. I've skied in Europe, but never been to the Dolomites. So you're going to be my tour guide, whether you know it or not.
Please come. We also have a little bit of an event that we do here every year, the Como Sports Summit, which is a little bit like Sun Valley for the sports industry, certainly this side of the pond. We've got some American and Latin American people as well. So you must try and put that into your diary because it's a super, super cool event.
When does it take place?
This year will be September 1920. It's usually about the third week in September.
Very cool. I've never been to Como. My wife lived in Italy for a while. She speaks Italian, so maybe I'll bring her along as the translator. I read your book. I was just in Japan. And so there's a little link because your book has a very famous riff on a Japanese painting on the cover. And I've never quite read a book like yours. And listeners, you'll hear why as we go through it. But it was definitely unique and I loved it.
Oh, good.
I left it at work, so I can't hold it up today. But I have so many pages dog-eared, particularly for the quotes. I loved a lot of investing quotes you had in there. So I figure I'll start with a quote, which I think encapsulates a lot of the business of sports, why it's somewhat unique. You wrote, French football philosopher king Eric Cantona said, "You can change your wife, politics, or religion, but never can you change your favorite football team." And I hear you because I am a Denver Broncos fan. And the prospect of someone saying you got to cheer for the Raiders, it's just untenable. I don't even think it's a choice. Why does sport hold such a special, unique place in all of us?
Well, it is part of who we are. It is, as I say in the book, a little bit a connection to the generations before us. The first time we go to a stadium probably has been taken by a father or an older brother or an uncle or even a grandfather. And one of the things that I really like in the book, I don't know if you remember it, Meb, is that it's almost the place where it's easiest to break down that really awkward father-son silence relationship. That famous thing, how long did calls take between a father and a son? About 30 seconds. Between a son and a mother, 2 minutes, and a daughter and a mother, 2 hours. Guys don't speak an awful lot. The one place that they do speak is in the stadium. So you can't just treat sport like another product that you'll change your watch from Rolex to IWC, or you'll change your car from BMW to Mercedes. It's much, much deeper than that. And one of the things in the book is that when people try and treat all of that as an asset class, I think in many ways they're asking for trouble because they're attracted to that incredible customer and fan loyalty that they think is a golden ticket to super profits. But it is a double-edged sword and it is one of the hardest assets to manage for return. Eric Cantona's right. You can never change your team. Never.
Just you describing this with, I'm sure all the listeners, I mean, some of the biggest markers on my timeline of my life have certainly been marked with sports. The memories are so vivid for not just playing sports, but attending sporting events. You mentioned that about your father, and I can already think about 3, 5 very informative memories of my childhood of going to games, both good and bad. As I mentioned, I was a Broncos fan, so my childhood was littered with disappointment, many Super Bowl losses.
Yeah, but you had Elway, one of the greats.
Full-length poster of Elway in my bedroom as a kid. It becomes such a defining relationship and identity of people. By the way, who is your favorite football team?
Well, I'm from Scotland and I'm from an Irish Catholic background, so it's Glasgow Celtic, which, if you think of it, it's very similar to the Celtics in Boston, that whole Irish, bohemian, outsider type vibe.
Thinking about sports on the business side, it's certainly having a moment. You mentioned the Celtics. Celtics are now for sale. They just won the NBA championship and quickly announced they're selling. But you had another quote in the book that I thought was interesting. You said, investing in sport often generates this significant intangible return, not shown by the financial accountants, but always recognized by the best investors, even today. And said, sport is the exact opposite of a homogenous asset class. What do you mean by that? Talk a little bit about the investing side of sports.
Well, the first thing we have to say, Meb, is that the American sports environment is very different from Europe. And there's a whole chapter dedicated to that. And we can go into that in length if you want. In Europe, where most sports are founded, even your own, we could argue about what American football is compared to rugby, what baseball is compared to rounders, and basketball compared to netball. But let's leave that aside. That's a dry argument. But sport basically it grew out of public schools, fee-paying schools for the elites in England. And they started as amateur. They were the pastime of rich men, and it was always men. And the Corinthian spirit, after the Greek place Corinth, means that many people ended up owning what you call sports franchises for many other reasons apart from financial return. Whereas in America, sport was born from day one, I would argue, as a business. You immediately had an idea that it was an asset that was solid. First of all, you didn't allow everybody to buy in. Your leagues are closed, so there's no promotion and relegation. You have got a very clear cost structure with the salary caps, which builds in marginality. So they should make money. And there's another quote in the book that's from the TV show Billions, which says, letting you own a sports franchise in America is the way we knight people. And in many ways, that's true. But in Europe, it is very, very different. Starts out amateur, then it becomes the working man's recreation. And the working man worked in factories, in mines, in shipyards, in the way that we all know in the last 100 years. So the owner of that factory or shipyard or mine bought their sports franchise in many ways as a kind of like bonus for their workforce. And it became very associated with the local town. So that whole theme in Europe has gone on through various iterations where sport franchises haven't really been owned for what we call an income statement return on capital. It's been owned for, as I say, managing a workforce or marketing. When you get into the 70s and 80s and you got people like Silvio Berlusconi buying AC Milan or Bernard Tapie buying Marseille, they were doing that as part of a bigger play for their general business empires, and indeed, from both of those cases, political empires. So the sports asset has never been seen in Europe as a financial one. And they're all slightly different. If you buy a soccer team in the north of England, let's say in Blackburn, one of the old classic manufacturing towns, is very different from buying a football team in London, where really it's different now because money's changed everything, but London was never really a major location for soccer teams from the start. It's always been a working class Northern Britain, Scotland thing. So when people talk about, oh, I need to get into sport because it's an asset class, it's what they call an alternative asset class, they think it's non-correlated and they get super excited and they want to put dollars behind it. That's one of the reasons I wrote the book, because it's just set up for many of these things to fail, especially this side of the pond. And the book grew out of that once you start thinking about these major themes. One of the things I really love about thinking about all of this is that America is the land of the free. Competition, dog eat dog, be everything you can be, the American dream, capitalism to the nth power. Isn't it funny that the sports in America are almost set out as socialist? When you start thinking about that, your head goes in a lot of different directions. What do I mean by that? You spread all the monies more or less equally. There's no punishment for failing with relegation the way that we have in Europe. And guess what? The worst team gets rewarded with the best player in the draft. It is actually communist, monopolistic communist as a concept and as a construct. And when you start thinking about this and compare it to what it is like in Europe, you think, I need to write a book because this is poorly understood.
And for the Americans out there who aren't familiar, could you maybe just quickly explain relegation and how that works? A good overview you could watch, if you wanted to watch, was certainly the Ryan Reynolds show about getting involved in the European soccer team, because they kind of explain the relegation and some of the properties, at least of European football. But maybe give us a quick overview so people can get up to speed.
Well, as I say, we have got what really should be your mentality. We have got it in a European sport. It is a total meritocracy. In theory, the team here in Como, if I get behind it and become good, I can move up the various divisions and I can end up playing in the top of Italian Serie A and then in the Champions League. If you win your league, you will be promoted to the league above you in the pyramids. If you lose your league or in the bottom two in the league, you will go down to make space for the ones coming up. So it is the definitive meritocracy, which is its beauty. All of us in Europe think that that's the secret of it, that somebody who does well gets rewarded and vice versa. But it's also its biggest weakness financially in terms of a business model. But it is incredibly important to understand this. The construct of American sport is fundamentally different from European sports. So that, to answer your question in the most easiest way, is why it's not a homogeneous asset.
Very popular personal growth guru recently came out with a book in the United States. Now, the title was called The Holy Grail. And I think he probably does a lot of good. He certainly has millions of fans, but ignoring the title, because that's already sort of inflammatory. If you've been involved in the investing world, anytime anybody says Holy Grail, you want to run the other way. But one of the chapters was dedicated to investing in sports. And so I don't know if this is a sign of the times, because at least the media that I see, the big splashy headlines are all past performance. We always say past performance, no indication of what's going to happen in the future. But all these sports owners, hey, I bought this team for this and I'm selling it for $3 billion. Mark Cuban's selling some of his team right now. You see, and so I think a lot of people believe, they say, oh man, I want to get in on this. This is clearly a great investment opportunity. And private equity is probably chomping at their bits too. How do you think about it?
That is a big question and probably the key question. And the first thing I would say is that we have in sports assets the same as we have in any other assets. We have bull markets and we have bear markets. I know your podcast and the audience of your podcast, so I won't spend too much time on this, but in very simple terms, in bull markets, assets and the companies owning those assets are valued at a higher multiple of revenues and profits than they are when they're in bear markets. And I would say this, Meb, the sports industry basically has benefited from 30 years of the growth in the media sector and hence sports media rights. What do I mean by that? When you have got new platforms that need to get penetration in the media sector, whether that's cable, whether it's the streaming wars now, or all different versions of that over the years, the main asset you need to drive penetration is sports rights. So sports rights have gone along pretty much correlated with the growth of the media sector for the last 30 years. And I could bring that straight up to date by talking about exactly those streaming wars, this idea that we were all going direct to consumer, we were all going to have all these different plus platforms that all needed to have content. Well, guess what? They pushed up the price of sports rights, and hence the franchises who get most of their money from those sports rights, their value has gone up as what you would call a fundamental number. Then the bull market and the idea, if you want to call it the everything bubble, has pushed those valuations of revenues through the roof. It's the same in sport. And one of the things that you know much better than me is that when bull markets happen, they go through a phase where the very frothy bit of the top is when everybody rushes in and everybody, including the taxi man, including the shoe shine person, they're giving you tips about what to buy. So my book in a lot of ways is basically saying I'm calling a top on sports rights, and hence I'm calling a top on valuations. And we should be very, very careful because basically you need to say this. The value of sports assets is hugely dependent on how florid the performance of media companies are. The media companies over 30 years have had an excellent model called the cable bundle, where the marginality of that bundle was extremely high. I'm talking as very simple accounting here, extremely high marginality. The bundle has always worked for that reason. It's worked in my old sector of the music sector, where an old long-playing record called an LP or an album, you sold it for something when you really were only selling what was a hot 2 or 3 singles. That was a wonderful model before technology unbundled that and allowed you to buy directly. One could say bundles are everywhere we look, even in other parts of the media industry where a talent agency will offer whoever's wanting to make a film a collection of their clients, from the screenwriters to the director to various actors. Bundles as a business model are just wonderful, which means that when the bundle is broken up for whatever reason, and it's normally disintermediation of technology, you find yourself in a business that is much less profitable in terms of marginality. So when everybody rushes from the old way of doing things to streaming platform A, B, C, or D that are called Paramount Plus, Disney Plus, ESPN Plus, Fubo TV, all of that, I'll tell you what, it's just a lower margin business, which means they cannot, in terms of an income statement, offer to pay sports rights of the value the way they did in the past. That is starting already to work its way in to most of the sports rights. The reason that you've still got a lot of people not seeing that is because the premium rights of sport, and again, I'm just talking about America to make it easier, which are obviously the granddaddy of them all, the NFL, the MLB, and the one that's very recent now, the NBA. They are so popular that it makes the people that are bidding for them probably buy too much under the heading strategic premium. That's always a misnomer for paying too much, but they don't really have a choice. And we can get into that a little bit more if you want to, where Zaslav is with Warner Discovery now and the NBA. But basically, I would suggest to you, to answer your question, that what we are seeing here is what you call in finance terms the mass market, or even the retail market, getting into the very top of a market, when the smart cookies, and you can call it Cuban, you can call it the people that own the Celtics, or you can call it a lot of other things, they realize that the top is in.
It's fun to read your book because you're talking about all the negotiating and how some of these media packages, there's so many tectonic shifts going on right now. You've seen some of these non-traditional players really get involved in the US, and part of the media side is the ability to have personalization. You got YouTube, you have Amazon, these big tech companies starting to get involved in some of these situations, which I'd be curious to see if in a few years it's not Paramount, but maybe Google involved in some of these setups.
I think that's a really important point. Everything I said about the media sector and its model a second ago is all true. The new people who are coming in are not pure play media companies. If you take Amazon, we know what Amazon does. It sells you stuff. And what they're doing in sport is basically a way for you to sign up to Prime and have you on a subscription, then the whole ARPU play and everything like that. Apple, that's starting to sniff around sport, we know what Apple does. It sells iPhones, principally iPhones. If you look at Apple, all its numbers are really still on the iPhone, etc., etc. Google makes its money in another way. So that is one of the big themes, that are these people going to look at sport in the correct way? Are they going to do it in a different way? Because when you look at how they're all approaching it now, one of the big things that the leagues do everywhere in the world, and especially in America, is they've now got into this idea that the best way to make most money is to split the games that the fan can watch across as many platforms as possible, which means what I believe is a train crash in the making, because sooner or later, especially in the middle of a cost of living crisis, where interest rates are going up and credit cards are going up, there's going to be a point where that price inelasticity doesn't work and they're going to push back. So all of the things that you're talking about, there's so many ways that we can look at this about who's going to be driving the value of sports rights and hence sports franchises. In the past, it was the cable bundle. In the future, it's going to be another company. But there's other elements to it as well. The way that the book looks at this, part one, it talks a little bit about what sport is and some of the things we've talked in the last 20 minutes about the difference between American sport, European sport, how the media sector has affected it, the business models, the role of the fan, the loyalty of the fan. The second part of the book is a very deep finance book and talks about some of the things that you probably talk about a lot on here, macrofinance, the way that the world has perhaps had a huge amount of growth over the last 30 years, financed quite a lot by excessive debt. That leads into all the things about the murky world of finance and how many rabbit holes you want to go in there. It talks about the various providers of capital, private equity, venture capital, and now obviously sovereign wealth funds coming from the Middle East. Third part of the book talks about some of the things about how you manage sports assets and business in general, and some of the things that have been forgotten in the era of easy money. One of the things I love is something called the Pareto principle, which is that old saying that says that 80% of everything that you do or get comes from 20% of your products or your customers. So that's fine when money is easy and cheap, but when it isn't, you have to think, well, why should I bother servicing the other 80% that's not really doing too much for me? In the sports sector, that means all the rights that are not those big three that I said earlier, the lacrosse league, even the Olympics you mentioned, all these other sports that in a florid media market got a media bid. I believe there's a chance they go no bid going forward for the reason of the Pareto principle. And the last part of the book, Meb, is this one, which I'm basically saying, where is this storm coming from? It's coming from different areas. The first one we've mentioned, which is the change in the media sector. The second one, which is super important, is the demographic change. Whichever way we want to cut it, your kids are 7, mine are a bit older than that, they're 20, 21. They consume content very differently. They've got no real concept that content needs to get paid for. They have grown up in a world where whatever they wanted was available to them pretty much on a whim and free. And if they can't get something, they'll get into piracy very, very quickly and adeptly. So as the boomer generation ends and it's being replaced by Gen Z and Gen Alpha, you need to ask yourself, what are these kids going to pay for in terms of sports? Because, again, let's just focus on America. Correct me if I'm wrong, but I think it's really expensive to go to sport in America. These kids do not have this disposable income that we had in our generation. They just don't. We could have a whole different podcast about how it's so much harder now and how Starbucks costs $7 a coffee and all of that kind of stuff. The disposable income is not there. This is another problem facing sport. The last one is what I mentioned a little bit earlier. When the bundle disappears, what it's replaced by is a very keen idea of what attracts eyeballs, advertisers, subscriptions, and money, which basically means the eyeballs go to what I call Hollywood. There's a big part in the book about the difference between Hollywood and art house, and that goes into the theme that Martin Scorsese would talk about in the film industry. Woody Allen's mentioned it as well, and Seinfeld as well recently. The broad spectrum of offering that was there when we were growing up is no longer there. You have to go immediately to the very top end of the market to have a chance of making a business out of this. And that means that some of the leagues that are around, let's take another example in America, the NCAA. The NCAA used to have all these conferences. That's going to 2 conferences. That's market forces based on polarization, the unbundling of what was there before, and people being able to pick exactly what they want. So that's why the book is called A Perfect Storm, because it's not just the media sector that's changed and that's going to cause us problems. We've got a whole new generational thing that I like to say, how many crooners and jazz guys were around after Elvis arrived? Young generations don't do what we did just because we hope they do. There's a chance that sport completely loses a generation to gaming, to metaverses, to all the things they do on there. And you will have noticed probably already that your boy will struggle to watch an entire basketball game. They'll maybe come in for the fourth quarter. They'll maybe go on to YouTube for the highlights. But here's the thing. Our sector, Meb, has sold the whole 80 minutes, 90 minutes, 4 quarters, and it's sold a regular season as well as the playoffs. I tell you what, I'm not sure the regular season is a product that's going to stand up in this world of polarization. Who's interested in all these games during the regular season? Who's interested? So all of these things need to be thought about, and you need to think who are going to be the winners, who are going to be the losers, and what is the way forward. And I just get the sensation that I am a contrarian. I'm not a Cassandra, but I think I'm good as a stock picker, as picking the top of a market. And I believe we're at the top of the market. And it's incredibly interesting to see that private equity, which you mentioned earlier, is coming in to this sector, I think, at precisely the wrong moment.
Oh man, a bunch of follow-ups there. One was we were just traveling and my son, we were watching TV in a hotel because we don't have really our generation's TV at home. We have TV that you can rewind and skip and play on demand. And we were flipping through the channels. He's like, hey, put on Disney or whatever. I'm like, no, you can't just summon Disney. These are the channels you have.
It's linear TV, yeah.
This is what's playing. He's like, rewind to the beginning of the episode. I'm like, you can. He's like, play the next step, skip. I'm like, no, you don't understand. This is the menu. I was like, back when I was a kid, we had to get up and turn the dial on the TV. And he's just like, whatever, dude. Whatever, Gramps. And then the second funny part is we're talking about sports. As we're talking about bull market, there's a lot of money out there that's not price conscious. So the new ownership of my team is the Walmart family. They have more money than just about anybody on the planet. And I was thinking locally to my little block here next to my office in Los Angeles, and there is 3 yoga studios on the same block. There's no way a single one of these is economically viable, right? Like there's no chance that people may be doing it for other reasons. And so thinking about the ownership, and you got the Saudi money coming in and all of these moving forces, it's an exciting time because you see the WNBA, a great example this year, people's preferences changing, on and on. But the big one that seems to me like a giant force that's reshaping, particularly here, is the gambling, where you have popular podcasts like The Ringer, where they spend the whole time talking about lines and odds and betting. And now you see it everywhere in game betting. And a lot of it, of course, is degenerate. And you see it in markets too, 0-day trading, all these things going on. Is that just like a correlated part of this shrinking attention span or highlights where the gambling part of it, are these two forces going along together?
That's a great question. One of the themes of this industry is the kids can't stay in front of the television for the whole of the game. You need to keep them engaged. That's why things like fantasy have become so important. Some of the games are being watched, frankly, because people are obsessed with their fantasy teams and all the stuff that goes around that. Fantasy is an entry drug to betting, to be honest. And gambling is a huge market. You guys have just had it opening up. We've had it since forever, and people love a gamble. That is going to be a big part of it going forward. And then you come up with things when you start thinking like that, and we all get a little bit romantic about Eric Cantona at the start of this podcast. You start saying things like, well, is sport content going forward just fancy customer acquisition? Way to get a cheap CPA, to use marketing terms. We'll put some games on, they'll come, and then we'll sell them betting and fantasy, and hopefully sell them some merchandise, guys like Fanatics and everything like that. That's part of what I would call the day-to-day debates, micro debates of this sector. Gambling and the American market opening up is one of the bull cases for the assets. I'll come back to what you said earlier to give you a couple of other bull cases. Sports are trophy assets. And as you said, some people don't care what the price is. Sovereign wealth that are buying into sport, some say for soft power, others say to diversify their economy away from carbon. They don't really care what the price is. And isn't it a wonderful sector when you've got people that will put down any check? So one of the things that the book talks about is that when I advise people that come on and say, what should I buy in sport? It's so hot. Everybody seems to be making a lot of money. I say to them, what's your objective here? Do you want to be knighted, like in Billions, by owning a sports franchise? Or have you got some concept of wanting to make a financial return on this? Because you need to tell me that up front, because the answer is there are two different ways that we go. And if you want to make money on this, and I would suggest that private equity is de facto trying to make money on this, you have to be very careful what you buy and what you don't buy. And I'll give you an example. It's in the book, but it's worth saying again. You've got a company there, private equity company called Arctos, one of the big sports investors. They have taken an investment in a soccer club called Paris Saint-Germain. They've taken a minority interest. And the only way they can do that is that they think that the value go up higher in a future. Because what does private equity normally do, Meb? They tend to be quite active in correcting an underperforming, flabby asset and bringing their skills to get it into shape. Forget the financial engineering bit of it. I'm just talking about operationally what they do. Well, firstly, you can't do that with a minority interest. Secondly, the person with the majority interest in this case is Qatar, a national sovereign wealth fund who frankly don't have any interest in making a return out of Paris Saint-Germain. It is absolutely a tool for soft power. So I would like to, and always do this, ask the investor, in this case Aptos, what was your thesis for doing this investment? Because I cannot see any single one that you've got any reasonable prospect to make a financial return. What I suspect they would say to me is, getting close to Qatar opens up a whole lot of different business for us in other parts of our business, whether it's investing in other assets and everything like that. And that comes back to what we said right at the start of this podcast. Sport is not a homogeneous asset. Sometimes it is just the entry ticket to get you into the right rooms to do other deals where you will make your money. And sadly, I think that's what makes it so difficult to invest for profit correctly in this asset class.
You have a chart that's definitely the first time I've ever seen this chart in the book, and I'm not going to spoil it because you got to read it, but it's CAPM applied to sports teams. We may have to screenshot and put the show note links, listeners. It's really awesome where you're looking at 3 or 4 various teams, how to think about it. I've never seen that interpretation, but I loved it.
Can I talk about that a little bit? Because I think this is super key. What is capital asset pricing model? It's basically a way of calculating the cost of capital with the one major variable, which is the risk factor of that asset. That can be country risk, it could be sector risk, or it could be company risk. And that's got a name in corporate finance called beta. And that's why I laugh when people say sport is non-correlated. What does that mean? It means that if everything goes to hell in a handcart in the general economy, sports should be okay. And the thinking there is it's okay because of the loyalty of the fans and the stickiness of the long-term multi-year deals for sports rights. But in reality, sport is very correlated. The major people who buy sports assets are people like ABC, NBC, who, if I'm not mistaken, make their money on advertising. Advertising is incredibly linked to the budgets of the marketeer big brands, whether that's a big bank or whether it's Procter & Gamble or whether it's a beer company. Those are dependent and quite variable depending on where the general economy is, recession or boom. So sport, in a great part of it, is very high beta, maybe extremely high beta. And I've used all these examples of pricing. An American, I think I used the Patriots in the book, pricing the cost of capital for the Patriots with Liverpool Football Club, which is a big club in England, with a smaller club in, say, Italy, and showing how the beta changes, how it changes for all different kinds of reasons, including the country risk and also the obviously and the underlying interest rate in each particular country. And it comes out differently. And I ask in the book, when people are assessing in their modelling what the valuation of the asset they should bid is, are they changing the cost of capital for that beta, or are they applying the cost of capital for the company that they've got just now? And one of my favourite parts in the book is this. Maybe we can discuss this. You give me your opinion on this. The example is, if Warren Buffett with Berkshire Hathaway, one of the most riskless and hence lowest cost of capital companies in the world, if they decided to have a look at buying sports rights, let's say they wanted to buy the MLS, a whole league, something like that, what should the cost of capital be that's put into that model to assess that? Should it be Berkshire Hathaway's cost of capital? Well, what is it, 8, 7, 8, 9, I don't know. Or a risky cost of capital for an emerging sport, soccer, in America that is not established and has got a one-trick pony asset called Lionel Messi. I would say the cost of capital is significantly north from 6, 7, and 8. But these mistakes are happen all the time. Just because you can get access to debt finance at 5%, that's not how you should model your discounted cash flow in assessing a sports asset. But in a bull market, what happens? People don't do their diligence. People don't look for their covenants. You get covenant light stuff. In a lot of ways, we have forgotten what happened in 2007 and 2008, and the whole sector of sport is what I like to consider underpriced risk. And there's a lot of bad deals getting done. I don't know what you think about that. That's my view. They're underpricing a lot of the risk.
A lot of bull market behavior is a little nutty. We did a poll on Twitter about a year ago where I asked investors if they invest in US stocks, and 92% said yes. And I bet the other 8% just accidentally hit the wrong answer. So basically everyone owns US stocks. But then I was like, would you own them? Would you buy them if they traded at a PE ratio, the broad US stock market, a PE ratio of 50? So higher than they've ever been in history, higher than a 99. And 2/3 said yeah. And then I said, would you buy them if they hit 100, which is higher than any country's ever been in history, including Japan in the 1980s? And still half said yes. So there's definitely a price insensitive world, and this tends to be a bit of a bull market phenomenon. I imagine these answers would be different in 2009, maybe even 2020, 2003, 1982. When I was last over in London, this was a few years ago, at peak Brexit, and having some pints with some friends, and we went up to Scotland. Man, in the UK stock market was just stinking it up. The mood was much different than it is somewhere like the US, which was hitting all-time highs and romping and stomping. So I think you definitely have the equations and the Excel and the cash flow, the inputs and assumptions get a lot more lenient when you're bull market territory and everyone's flush than when the opposite is true, I think.
Let me give you a couple of examples on that.
Yeah, please.
Everything's great until it's not, isn't it? Valuation, the way we've done this in the book is we've gone through all the classic ways of how you teach how to value something. I won't go into them here, but it's classic corporate finance. And then you get the other way of valuation, which just is an equation of demand and supply. And if you've got very few assets, there's only one Boston Celtics, there's only one Denver Broncos. If you've got very few assets and a lot of demand, the price just goes up well beyond the fundamentals. And that's where we are here. Let me give you an example in the music industry. There was a company, Hignosis. I don't know whether you ever heard of them. They got into the game of buying music catalogues of big artists like Neil Young and things like that over the last 5 or 6 years. And since I come from the music industry, I know a lot of people there, and they were bidding top dollar and then some, and then some. And everybody says, this is crazy. And the answer was, this is all public knowledge. The guy was saying, this kind of IP is rare. It's like peak oil. It's like the amount of gold you dig out of the ground every year. It's rare. So all of that. And people backed him. Hypnosis was a poster child of everything that was the IP play in the financial markets as an asset class. It went bust. Was picked up by Blackstone, I think, a couple of weeks ago. CEO removed, shareholder revolt, Blackstone came in. That's the reality of it. Everybody is fine with the valuation of Nvidia, of Apple. Frankly, I don't even think they know that they're investing in these things because it's all passive investing anyway. But let's assume they do. Everybody's fine about owning Nvidia until something bad happens. So then you're in the game of timing when what our common friend Grant Williams calls the end game. And you get into this phase where the fundamentals don't make any sense anymore, but everybody's still on the dance floor pumping up the demand. I suggest we're in that moment in the sports industry as they were in music catalogues a couple of years ago. And people should be very, very careful. They should use people that know the sector, that know finance, and can say to them, I can advise you, but you need to tell me what you want to do, what you think your exit is, and how you think you can improve this asset. Because there is no way on God's earth that the valuations of sports assets should be anywhere near where they are just now. Cuban knows what he's doing.
There's been a little bit of a shift in discussion, and it hasn't fully developed yet. There's always been this centuries-old conflict, push-pull between labor and capital owners. And so you have all these owners, some of which are monopolistic, some are a little more fluid, and some are socialistic. But on average, the players are not the owners, or they do not have ownership. And so while everyone in the US, I feel like, is very free market capitalistic, at the same time, they're like, oh my God, Jason Tatum is getting paid this. That's way too much. But then if you're like, well, if he's not getting paid this, then it's just the owners and he doesn't have any ownership stake. You had a very almost short paragraph in the book that mentions an interesting model about the new triathlete league. But what I'm getting at is there going to be a trend? Why hasn't there been a trend of the athletes starting to campaign or negotiate for some form of ownership and equity rather than just salary, as large as that salary is? Is that something that you think will be a trend? Is it a league-wide sort of idea, or is this something that the owners are just going to go screaming, no chance?
Listen, that's a very philosophical question. It takes you into the world of trade unionism. What you're talking about is individual negotiating of your market worth and your leverage. And a world-class first draft football player could say, I'll come to your team. I forget how the mechanism is, but you need to reward me with some stock options, the way that it works in normal companies. How can that kind of case-by-case negotiation happen when the players' unions in America are so embedded? I'm getting a little bit above my pay grade here because American sports isn't really my thing, but I tend to think the idea that the owners negotiate with one person, are we giving you 50% of the revenues? Are we giving you 53? Is it 47? I think that's comfortable for them because it gives them certainty and marginality. If you have to do it one by one, it gets awful complicated. And then I think you start to have issues, certainly with team sports. Team sports, there has to be an element that we're all in it together. And the idea that it's just somebody's got equity and somebody doesn't, it should work. But I did an article on all of this on trade unionism in sport, and I'm not sure. I'm now working a little bit on what's happening in the NCAA with everything that's changed there. And that's a great example. You've got all these naming, image and likeness rights that basically has ended the amateurism of university sport, which means that it's a little bit of a free-for-all and models need to change. People need to do different ways of perhaps putting these image rights into a media company. This is what this company I work with does. It's called College Sports Company. Very, very interesting. They work with people like Penn. They work with some other big universities as well. And they're basically turning the athletics department into a media company. And the equity of that new media company may go to various people. It may go to some of the collectives, the school themselves, and maybe some of the key contributors that are athletes. So I agree with you. I just wouldn't underestimate how ingrained in the culture the idea of player unions are in American sport.
We've talked a little bit about the risks and the dangers and the minefield, but you're involved in consultant and investing side of this world. Are there any either macro areas of sports that you think are interesting? So maybe you're like, man, I'm all in on cricket, or more specific verticals or areas that you think are really interesting in the whole sports ecosystem?
Good question, because obviously if you say something that's an industry totally adrift, that's not very useful unless you've got something to offer as a way forward. There are various things that I look at when I'm doing my own investing or when I'm advising others. One of them, I think this is one of the all-time special situations markets now for somebody who knows what they're doing and can use capital, both debt and equity, at the right place in the balance sheet in a structured way to de-risk the investment. I think there's a lot of sport tech companies that were playing the Silicon Valley model of scale, scale, scale. We'll fund your losses. We'll do your next round as well. Scale, scale, scale. And the venture capital industry overnight, basically 2 years ago, just went, got to get to break even. That has left a lot of very good assets and technologies, tech stacks, founders, business development teams, client traction and product market fit on the market for dimes on the dollar. And I think this is a great special situation and consolidation play, because whilst capital was free, everybody could afford their own tech stack, could afford their own go-to-market biz dev team, could afford all of these things. When it isn't, you've got to start merging them and looking for synergies. So one of the things I really like is the roll-up consolidation, build and buy play. If you can do that, I mean, you need to know what you're doing. You need to know what's good assets, what are bad assets. So in sport tech, I really like that one. I like distressed investing in general, as I said a second ago. The other thing I would like is where major institutions are being attacked and models need to change. I've mentioned the NCAA. I think there's going to be a huge amount of opportunities there. Private equity are already, as you say, sniffing around that. That's a very interesting macro change. I would go as far to say it's a paradigm shift. College sport is a major part of American culture, a major, major part. And it had a model that worked almost unchallenged for, 50 years, more than that. Now it's the Klondike. It really is. And that's why I've decided to work a little bit in that area. I think that's quite interesting. The other things that I like in general, Meb, are convergence plays. For people that don't know what a convergence play is, it just basically means that you buy an asset that will, by definition, end itself up in a stream that reprices it to other assets. When the euro came into play 20 years ago, the debt of countries like Greece and Italy and Spain was very, very highly expensive. But being part of the euro, it converged into what it is today. And in sport, one of the things there, and again, we're going to Europe here, so maybe people don't know this, European sport is really dominated by the big five media markets: England, France, Italy, Spain, and Germany. So there's a lot of very historical franchises in countries like Holland, Turkey, Portugal, Scotland, Greece, that have been cut out of the big money media rights, but they're historical teams of real brand value. If you buy them just now and you're a believer in the ultimate Super League play, which again is a European thing, it basically means that we end up with the same model as you guys, that European football would be a version of the NFL with closed leagues and everything like that. That's a convergence play. As long as you know that that's what you're betting on, that's why I always ask up front, what is your thesis here? My thesis is I want to buy Ajax Amsterdam because it's one of the most glorious and storied franchises in European football. Holland is a market that is undervalued just now, and sooner or later Ajax will end up in the Super League. That's the kind of thinking. One last one, you mentioned cricket. I'm a great believer in the destiny of demographics. Big theme in the book, destiny of demographics, the end of the boomer generation, the rise of Gen Z we talked about. Whether we like it or not, the people that like cricket are Indian, Pakistan, Sri Lanka, that part of the world. They tend to do very well as immigrants. And they do very well as immigrants in America as well. There's a lot of them. So just in terms of a general play on the demographics and the rich audience, I would have a little look at the prospects of cricket in the Americas for that reason. These are the kind of ways my head goes.
Every red-blooded American who grew up playing baseball, we're all convinced that we would all just be amazing at cricket. I've never played cricket, but there's a fantasy of every American where you're like, you take these pro baseball players, they would destroy cricket, which I'm sure is offensive to every cricket listener there is. But there was a stat, and I'm trying to remember, I'm sure it's in my Twitter feed somewhere, where my jaw dropped when I heard this, because it's such a stark stat, where it was like, there's more fantasy cricket players in India, so people playing fantasy sports cricket, than there are Americans. So there was 400 million people playing fantasy cricket. And I was like, oh, that puts it a little bit into perspective, where you're such a narrow view of what's going on and related to sports that are popular in the NFL and NBA. And well, there's an entire continent of people that, have different preferences. And so I was trying to think a little bit, as you were talking about that, about next 10, 20, 30 years and some of the emerging markets of China, India, the young population in Africa, which Africa seemingly skews a little more soccer. I know NBA has a huge effort development, NBA Africa. What's the Chinese? What's their sport? Is it basketball at this point? What are they super into? I don't even know.
They're big on table tennis. Badminton in Asia is very big. Kabaddi, which is what you would call wrestling, sumo and everything like that. Listen, the international sports market, different to the American one. American ones, forgive me, but you call things that you do the World Series, where it's only in America. So we laugh at that a little bit.
Yeah.
The international sports industry has looked at what you've been talking about for a while. The issue is, and I think even more so now, is what people can pay for. It's okay having the big numbers. There's X billion people in whatever, India or China or something like that. How many can afford a subscription? How many, et cetera, et cetera, et cetera. That's why I like the idea that a rich immigrant population of that kind of demographic in North America, and the numbers there are big, they could very easily be translated into a product that makes some money. And this is the kind of thinking you have to do. And there's examples of this all over. You mentioned triathlon a little bit earlier. Why do I like triathlon? One of the reasons is it's not a TV product, which means it doesn't have a lot of media money, which means it shouldn't suffer if the media sports right market goes down the way I think it will. Where does it make its money? It makes its money from cities that host their events, like Formula One, same model as that, and participants. It's amazing. In our world, finance, investment banking, what I would call the professional classes, how many people run triathlons? These have got a high net worth, disposable income, and they pay a lot of money to participate in triathlons. So that is a multi-revenue stream model from a rich audience, a rich demographic that I think you can build a business on. Conversely, any sport that's thinking sports rights will always go up and right into the north, I think they're going to get a punch in the face, because for the reasons I said before. But the opportunities are out there all over the place, both on the distress side for existing assets or early things like, as you say, cricket in North America. The challenge is to not think it's a homogeneous asset class and to think that you can just apply a normal playbook to it. Every place is going to be different. You buy the Mets as opposed to the Giants or the Yankees. Those are all in New York, but they're different things. There's a different dynamic everywhere. And I think that's the beauty of sport. You can be a good owner. You can make some money out of it, but you have to fall in love with the tradition and understand where this asset comes from and respect it. And sadly, there's a lot of finance people that don't respect it. They just look at it as transaction fees and let's get this deal done and move on to the next one.
What's on your sport bucket list? You got one to do?
I've been to a Rose Bowl. I haven't been to a Super Bowl. I do love American football. I'd like to go to the finals of the NBA. I've done most of the other things. One of the things I would say, which is probably unusual, is that there's this game in Argentinian soccer, which is called Superclásico with a Spanish accent, which is River Plate against Boca Juniors, which is one of the most frenzied rivalries that you can ever get in sport. And you go into that stadium, and even getting the teams to the pitch is actually a security issue because people are so passionate. I think my answer is there is a lot of beautiful things in sport that are also local. I don't think it needs to be, I need to see the 100 metres at the Olympic final or I need to see the Super Bowl. There are some small things that are just so particular and so passionate that they can carry you away. And those are the ones at my age that I'm looking for.
Well said. I got to see one of the best college football championships at the Rose Bowl when it was USC Texas, Vince Young, Matt Leinart, really a great game. But I'm trying to think what's on mine. For me, it's probably soccer. I haven't been to any of the really big games. I get super into the World Cup. That's only every 4 years, but I could see getting more into, I'd love to come see some big European soccer games. So that's high on my to-do list. I've checked off most of the US pro and college finals. Still haven't seen college baseball. I'm trying to wait for my university to get back in.
Let's take the example of baseball to be specific, just to talk about this a little bit. Even for us non-Americans, baseball is mom and apple pie. It's Babe Ruth, it's the Curse of the Bambino, it's Field of Dreams, it's Harry met Sally when they're in the baseball stadium. It's important culturally, but sadly, Meb, that generation is dying out. And you have got a product which you then take it away from the glory of its traditional sport and make it merely as content for the entertainment market, which is too long, slightly complicated with all the stats if you're not super into it. It's quite difficult to even enjoy it because you don't know what they're talking about. And then you've got these endless games in the regular season where this is one of the things sport hasn't got its head round. Less is more. Saturation of a product and throwing more and more games at something, all it does is kill the value. And that's why they get the NFL as the granddaddy. Limited season, not too many games, and then they keep it going with the combine and the draft and everything like that. I'm not bullish on baseball and even basketball because the regular season, I do not believe is a product that is unique enough. It's oversaturated, and ultimately you don't get value from oversaturated. And these are some of the conversations that my industry doesn't want to have. It wants to keep growing that revenue line, more games, and players are getting injured all over the place and everything like that. The secret, like the luxury industry, is less is more a little bit. We don't make a lot of Ferraris. There's not a lot of NFL games. I loved when you were speaking with Peter Atwood and Grant and you used that phrase, the velvet rope industries. That thing that you're doing something so beautiful and so unique that you can charge a lot of money for it. And that's one of the things that I think sport needs to do, at the same time making sure that it's not priced out of where it comes from. And ultimately that comes down to segmentation of the product. These are all the operational things we talk about every day in the industry. But baseball, if it dies, that's a tragedy because it is part of Americana. That's the best word I can use for it. It is part of Americana, even for us, not Americans. And they need to think a little bit harder about how to save it.
Yeah. Well, other countries, you see as certain sports take off around the world, certainly baseball in certain places, still very popular, Japan, Caribbean, other places. But it's a great comment. I grew up, I knew probably every player and every stat. And I'm thinking here in 2024, I would be hard pressed to name more than 20 players. Now, granted, my team is terrible. So Colorado Rockies have been irrelevant for majority of my lifetime. So that may be part of it. And I think I can name one Colorado Rocky currently, sadly. But I hear you, 100 plus games is a lot. Unless you're going and sitting in the outfield and eating some hot dogs and drinking beers, watching those on TV. I don't know who does that. Maybe a Red Sox fan watches all those.
Let me ask you about your son at 7 years old. What sports is he into?
Well, the example I was going to say earlier, I was laughing because I took him to a Lakers game when they were playing the Nuggets. And the things he was most interested in were the parachute pretzels. when they just threw parachutes in the whole arena and pretzels came down. And we also got to sit right behind the Laker girls. And he's 7, so girls aren't a thing. They're probably gross to him at this age as a first grader. But you could definitely see the wheels turning a little bit. There's something there being in front of these beautiful women dancing.
I love that.
Yeah, so I think he was most interested in getting on the Jumbotron dancing, which he did at some point. He was actually really interested in watching baseball, but he's just learning the rules and all the differences. We take him to a bunch of games, but it's also tough because I grew up, hometown is your sports, and so mine have been transplanted. So I'm not pressing him to be a Nuggets and Broncos fan, but I can't, for the life of me, going back to the beginning of our conversation full circle, possibly cheer for the Dodgers and the Lakers and the Rams. So it's a little conflict because he's a native of LA and me telling him he can't cheer for them and his friends. I don't know. LA is a weird place anyway for sports.
How does he spend his time on the screen or whatever it is? Where is he going? Is he gaming? No
screens yet, man. I'm holding out. I heard a good quote the other day. It's the day your child gets a phone is the day their childhood dies. So I'm going to hold out as long as possible.
Good for you.
On the screens. It's hard to make extrapolations from my childhood to this one, and I got a sample size of 1, but it definitely is different than my childhood going to Bronco games and a-hole brother refusing to open up the chicken soup thermos, people sledding down the stairs. Very strong memories. We usually ask people what's been their most memorable investment on this show. What's been your most memorable sporting event that you've ever attended? Is there one that comes to mind?
Yeah, it was a soccer game. My team, Celtic, played Barcelona with Messi in 2012. We were already a team that is disadvantaged because we don't have the money. We're in a small media market, so we were massive underdogs. And this was peak Barcelona in the Champions League, and we beat them. And there was just astonishment, and the place was great and everything like that. I guess that would be the main one.
Nothing better than the underdog story. I remember going to see a Broncos game when Tim Tebow first played. And I don't know if I've ever seen anything quite like it. It's like going to a Taylor Swift concert or something. It's just like you look around and what has come over everyone, but it's electric. And nothing's better than the underdog upset. That's the most fun of all.
Well, I mean, you say that. That's the way we think. I was speaking at a conference recently, a sports conference, where the guys from the Kansas City Chiefs were there. And they spoke very well. Think about this, Meb. They said, we have got a once-in-a-lifetime opportunity because we've got Mahomes and we've got one of our players dating Taylor Swift. And they came on there and basically said this gave them a globalization opportunity that was unprecedented. Now, they're not talking about the NFL. They're not talking about what their record is. What they're talking about is getting to new customers globally on the back of something that, in her case, is not sport. And this is what's happening. This is why, to come back to Scorsese, all the films these days seem to be Marvel Universe type things because they are homogeneous, they're global, and they appeal to everybody. And the little quirky ones don't get made anymore. And I'm afraid sports going in that direction. We're going to lose all the things that the music industry and the movie industry have lost with all the indie type stuff. And I personally don't like that. I think it's, as I say, the glory is in local. My hope is that people come back to actually the live event, a little bit like they have done in music. You mentioned the Killers earlier on a little bit. The music industry, when the CD died, it all became about the live concert and it had a little bit of a boom. I think if sport gets its pricing right, it can try and re-energize a little bit, the live experience as opposed to the TV experience. Because the TV experience, for the ones like your son, I don't think it's going to hold.
There's some places that are adapting and thinking of small markets. This is, again, only one that I can think of, but thinking specifically, I haven't been to one, but you see the highlights all the time of the Savannah Bananas who are taking minor league baseball, but an approach that's a little more entertaining and a little more suited for the short video clip world. Who knows if they're making any money, but at least they're trying. My goodness, Roger, I would keep you for 2 more hours. So we're definitely going to have you back. This has been so much fun. If people want to find you, you got a podcast, you write on occasion. I love whoever does your cartoons and graphics, give them a raise because they do a great job. I love the design. Where's the best place to go to find you?
You can get me on Twitter at RPM Como, as in Lake Como. My company is Albachiara.net, which is ALBACHIARA.net. And you can find me on LinkedIn as Roger Mitchell. And I'm always willing to have conversations and chats. I think curiosity when you're in the early stage game and you're trying to see the innovation that's coming around the corner is essential. So reach out and listen, thank you for this. I was a little bit nervous coming onto this because I know the quality of this show.
It's been a lot of fun. Listeners, absolutely go pick out his book. Again, it's a different sort of book. And I say that in a complimentary way, called Sports Perfect Storm. We'll put the link in the show notes. I look forward to hanging out in the real world, maybe having a pint and watching some soccer one of these days. Roger, thanks so much for joining us.
My pleasure. Let's work to hook up and do all those things.
Podcast listeners, will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.